Okay, we've got a deep stack of sources today. We're looking at the fourth quarter and full fiscal year 2025 results for a huge player in semiconductor equipment.
Right, and our mission here is to pull out the key numbers and, more importantly, what they're signaling for the future.
So let's just jump right in with the big headline. Fiscal year 2025, it's their sixth consecutive year of growth.
Sixth year, which, in a famously cyclical industry like this, that's incredible.
And the numbers back it up. They posted a record annual revenue of $28.37 billion. That's up 4% year over year.
And you have to look at that 6-year trend for the full context. It's not just growth, it's the quality of the growth.
What do you mean by that?
Well, over that period, their revenue has grown at a 12% compound annual growth rate, so a C up. But their non-GAAP earnings, that's at a 20% CAGR.
So they're getting significantly more profitable as they scale.
Exactly. They're not just getting bigger, they're getting much, much more efficient.
You can really see that in the margins, can't you?
Yeah.
The sources point to a non-GAAP gross margin of 48.8% for the full year.
Wait, 48.8%?
Yep, up 120 basis points.
That is a massive number. That's their highest gross margin in 25 years.
25 years. So what does a number like that tell you?
It tells you they have incredible pricing power. It says they're selling a really rich mix of their most advanced systems and their customers. Well, they have to pay for it because these tools are irreplaceable for high-end manufacturing. It's a huge structural win.
Absolutely. But even with that strong annual picture, the most recent quarter showed a little bit of a dip. Let's dig into Q4.
Right. The fourth quarter saw a bit of a softening. Q4 revenue came in at $6.88 billion, which was down 3% year over year.
And EPS followed that trend.
It did. Non-GAAP diluted EPS was $2.17, so that's a 6% drop from the year-ago quarter.
And breaking that Q4 revenue down, their main semiconductor systems group brought in $4.76 billion.
And their services arm, Applied Global Services, or AGS, added another $1.625 billion. So that brings us to the immediate outlook. What are they signaling for Q1 of 26?
The guidance suggests things are stabilizing. They're looking at total revenue of around $6.85 billion, plus or minus $500 million.
So basically flat to slightly up sequentially. And the profitability?
They expect to keep it high. Non-GAAP gross margin is guided to about 48.4%, and non-GAAP EPS right around $2.18, plus or minus 20 cents.
Got it. Okay, so we've got the numbers. They're strong, especially on the margin front.
Right, but numbers are just half the story. Let's pivot to the engine behind all this, the real driver, and that's AI.
It's all about AI. What's so fascinating here is that AI adoption is just. It's forcing massive investment in advanced semiconductors and in the equipment needed to make them.
The wafer fab equipment, the WFE.
Exactly. The source is called a virtuous cycle. AI demands more powerful computing, which drives innovation in chip design, which in turn demands more advanced manufacturing tools.
And that cycle is powerful. I mean, the forecast is for the whole semiconductor industry to maintain a 10-15% CAGR for the next 5 years.
Which, for a company like this, means growth isn't just about selling more of the same. It's about enabling these huge, revolutionary technology shifts. They call them inflections.
Okay, so if AI is the driver, what are these specific inflections they're betting on? Where's all that R&D money going?
It all boils down to materials engineering. These shifts are what grows the entire WFE market because they introduce new levels of complexity.
Let's break those down. For leading-edge logic, the sources point to two big ones: gate-all-around transistors and backside power delivery.
Right. Gate-all-around, or GAA, is the successor to the FinFET transistor we've been using for years. It's a total redesign to get better control over the chip's power.
And backside power.
That's maybe even more revolutionary. It's about separating the power lines from the data lines on a chip. It dramatically improves efficiency. Both of these, they require completely new tools and processes.
Then you got the memory side, which is obviously critical for these huge AI models. The inflections there are 4F2 and 3D DRAM.
Crucial moves. It's all about stacking more memory vertically to get the density needed for things like high bandwidth memory or HBM.
HBM is the perfect segue to the third big inflection: advanced packaging.
Exactly. Advanced packaging is how you connect all these different chips, the processor, the HBM, into one powerful package. They're focused on a tech called hybrid bonding.
Which gets you higher accuracy when connecting these tiny chips, leading to better performance and, crucially, better yield.
And we're seeing the products come out of this strategy. They specifically highlighted their new Kinex hybrid bonding system.
And on the inspection side, the new Provision 10 eBeam metrology system to help find those tiny defects in these new 3D structures.
But for me, The strongest signal of all came from the CFO.
What was that?
Based on their customer conversations, they are already preparing their operations to support higher demand beginning in the second half of calendar 2026.
Wow. That is a very specific, very confident, forward-looking statement. That's a roadmap almost 2 years out.
It's a huge signal of conviction.
Okay, so let's zoom back in a bit to FY25. How did the specific business segments perform?
The main driver, the Semiconductor Systems Group, SSG, grew 4% to $20.8 billion.
But the context there is really important, right?
It is. They hit record foundry revenue globally and record DRAM sales outside of China.
That's the key part. They posted this growth even while trade restrictions were seriously cutting into their China business.
It shows just how essential their technology is in the most advanced markets like Taiwan and Korea. They more than made up for the China headwinds elsewhere.
And what about the services business, AGS?
AGS was the stability layer, as always. It grew 3% to $6.4 billion. But the real story there is the composition of that revenue.
Right. It's incredibly stable. The sources say more than 2/3 of it comes from subscriptions.
And the recurring parts and services business grew by double digits. You're talking about a highly predictable, high-margin revenue stream.
Which brings us to a really interesting operational change they announced. They're restructuring their reporting segments.
Yeah, starting in Q1 of fiscal 26, it's all about increasing transparency.
So they're moving the 200mm equipment business.
Yeah.
It's going from AGS over to the Semi-Systems Group.
Right.
Why do that?
It's really for clarity. They want all the equipment sales, no matter the wafer size, in one bucket. But the strategic result is what's important for you, the listener.
And that is?
AGS will now consist entirely of recurring revenue. It makes it so much easier to track their stable, subscription-like services growth completely separately from the more cyclical equipment sales.
Got it. Okay, let's wrap up with the balance sheet. All this R&D and investment, it requires a strong foundation.
And they absolutely have one. Operating cash flow for the year was almost $8 billion. Free cash flow was about $5.7 billion.
And they ended the year with a huge pile of cash.
A massive pile. $12.9 billion in total cash and investments.
Their capital allocation strategy is pretty clear on how they use that cash. It's a two-pronged approach.
First, you invest in the business. They've poured nearly $25 billion into R&D over the last decade. That's how you stay ahead on those inflections we talked about.
And second priority,
return the excess cash to shareholders, grow the dividend, and use buybacks.
they have a commitment to distribute 80 to 100% of their free cash flow over time. In fiscal 25 alone, they returned almost $6.3 billion.
Which has had a huge impact. Over the last 10 years, their buybacks have reduced the number of shares outstanding by about 32%.
So we pull all this together. The narrative is
What?
a record year,
Mm-hmm.
incredibly high margins, even with those trade headwinds.
And it's all built on this innovation strategy that's just laser focused on the next big materials engineering shifts, AI, gate-all-around, HBM.
It's a very clear story.
It is, and it raises a really important question for you to think about. The CFO was explicit. They are preparing for higher demand in the second half of calendar 2026. The fact that they're investing in new platforms like Kinex and restructuring their segments to highlight that stable, recurring revenue, it all suggests an extremely high conviction in that coming demand inflection. So the question for you to consider is, how much of that anticipated 2026 boom is already baked into today's valuation, and what other new technologies could drive the WFE market even beyond that horizon?